everyone's like, oh, well, gold's anti-American. How is gold anti-American? It's the most American thing there is. Hey, you're Scott Bessent. You tell me I can't sell my treasuries? Screw off. I'm going to buy gold. That's freedom, right? Like that's what we were based this country on. Hey, I don't need your permission to do anything. I got gold. I'm going to go do it. So to me, the weaponization of the dollar it can't be unseen now. That's right. Exactly. You fly the wrong flag over your embassy, right? We're going to sanction your treasuries. Okay, fine. I'll just buy gold.
Yeah. The weaponization of global financial systems has permanently shattered traditional safe haven assumptions, forcing sovereign states and institutional investors to radically rethink their reserve strategies. Critics often mischaracterize precious metals, yet independent market participants view bullion as an indispensable insurance policy against systemic currency debasement. Lukegromen, founder of FFTT and a leading macroeconomic researcher, points out that physical gold represents the truest form of economic freedom because no foreign ministry or treasury department can restrict its private transfer. As global powers witness the freezing of international exchange reserves and punitive payment exclusions, central banks have aggressively accelerated physical bullion acquisitions to safeguard long-term national solvency. Gromen predicts that as monetary authorities find themselves trapped between severe currency volatility and mounting debt obligations, gold will serve as the ultimate structural escape hatch, surging multiple times over its baseline valuation in the coming years, and ultimately reshaping global monetary architecture. Now, we present the clips from Lukegromen's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The Fed are going to have to cut interest rates as soon as possible. September 18th, 2024, the Fed surprised with a 50 basis point rate cut. People thought it was all around Powell trying to sway the election. I don't think it was him trying to sway the election. I think it was him addressing this issue where they are stuck between two high, voltage wires. And if they go up to this one, the yen carry trade, yen gets too strong, it's a problem. Dollar gets too strong, it's a problem. And once you understand that that's the operating environment they're in, then a prudent person who was not trying to blow up the system would do whatever they could to manage to keep things calm. You wouldn't start a war. You wouldn't start a trade war. You wouldn't start a war. You wouldn't do any of these things. And
you need predictability.
Yeah, you need predictability. And so, we said in 24, longer run, it's going to be really good for gold because really gold's the only way out for these guys now. Once the dollar gets too strong, triggers a crisis, and the yen gets too strong, triggers a crisis, you're done. Gold's the only way out for them. And, gold since ends, I don't know, up 3x, 4x, something like that. But that when you look at that context of today, this is why the, leaks in the dam keep breaking out. This is 40 years of policy that are coming unwound, 35 years of policy that are coming unwound. And, the only question in my mind is, are they doing this out of stupidity or hubris? Or are they doing what they've done because they realize they're at the end of a 35-year runway? The U.S. used the dollar to hyperinflate Iran in 2012, right? We kicked them off SWIFT. We and the Europeans kicked them off the SWIFT system. Okay. We have weaponized the dollar against Russia repeatedly since 2013, 2014. And I'm not justifying the politics around it. I'm just saying, objectively, if you were a foreign sovereign country, okay, now it's happened twice. Then we weaponized the dollar against Russia again, 2022, froze FX reserve sanctions. Every year since, global central banks have bought 1,000 tons or more of gold. I was told people in the Middle East and longtime U.S. allies, they're still our allies, were quote unquote horrified by the implications of that. What are we doing now, right? With the trade war and economic D-Day, whatever this is that he's going to announce here, whatever, right? Like, your dollars are not your money, right? The UAE was like, hey, we're illiquid. We need a swap. Like basically, even if you hold them, you may not be able to sell them, right? There's no CEO, there's no Treasury Secretary of gold telling you can't sell your treasuries. There's no Treasury Secretary or American government of gold saying you can't sell your gold. What happened to gold when the war started? Gold prices fell. Why? Because people were selling their gold. Nobody needed a swap line. Nobody needed to backstop it. Nobody needed to do a gold buyback program to make sure long-term gold yields didn't get too high because too many people were selling gold. No, it just worked. You don't need anybody. Everyone's like, oh, well, gold's anti-American. How is gold anti-American? It's the most American thing there is. Hey, you're Scott Bessent. You tell me I can't sell my treasuries? Screw off. I'm going to buy gold. That's freedom, right?
Yeah.
Like that's what we were based this country on. Hey, I don't need your permission to do anything. I got gold. I'm going to go do it. So to me, the weaponization of the dollar it can't be unseen now. That's right.
Exactly.
You fly the wrong flag over your embassy, right? We're going to sanction your treasuries. Okay, fine. I'll just buy gold.
Yeah.
Decades of entrenched fiscal policy are actively unraveling as central banks navigate a perilous corridor between competing economic pressures. When monetary stability gets caught between a surging dollar and a volatile yen-carry trade, managing market equilibrium requires predictable interventions rather than escalating trade conflicts. Rather than enduring painful structural austerity during financial dislocations, policymakers consistently default to aggressive liquidity expansion. Over the upcoming decades, demographic liabilities will require massive fiscal monetization, projecting that authorities will print trillions of dollars to fulfill retirement obligations for aging populations. This immense fiat dilution is bound to erode paper purchasing power, driving raw commodities and energy costs significantly higher as the traditional monetary framework reaches its definitive runway limit. Consequently, global markets face unavoidable structural transformations that demand a complete reassessment of asset allocation strategies. Now, let's get back to the interview.
The PBOC in November of 2013, the People's Bank of China came out and said it is no longer in our interest to grow holdings of FX reserves, which translates to we are done buying treasuries. That was 13 years ago, and they haven't bought a single one on net since. As our debt in 2013 was probably, 10 trillion, 11 trillion, it's 40 trillion today. And the Chinese haven't bought an incremental treasury bond on net at the official level. So they stopped buying our debt. They have been essentially weaponizing the Eurodollar system against us for almost 20 years, which is shortly, they were happy to buy our treasuries. They were happy to buy our mortgage-backed securities, some equities, right up until 2008. They figured that we were going to honor our word, which was we will maintain the real value of your bonds. And then the great financial crisis happens. And when the great financial crisis happened everywhere else, Latin America, Southeast Asia, Russia, etc., the Americans through the IMF had always said, you need to implement austerity. You need to break up your big banks. You need to punish your oligarchs and restructure your whole economy. And it was austerity. It was pain, blah, blah, blah. When the Americans had that kind of a crisis, what did the Americans do? We're going to print the money. And the Chinese were like, holy cow, we bought all these bonds on the view that you would honor the real value, that you were going to treat the dollar as sacrosanct. But if you're just going to print the money, great financial crisis, whatever, but you owe your baby boomers $100 trillion. $150 trillion. You're going to have to print all that. The dollar is going to get crushed against commodities, against oil. Again, we're not going to be able to feed our people, or we're not going to be able to afford oil because it's all priced in dollars. And you're going to print $100 trillion over the next 30 years as the boomers retire and age and die off. And so the Chinese, after 2008, started doing a perfectly rational thing, which is they started lending dollars to commodity producers around the world. Right? The Chinese are running a big dollar surplus by trade with the Americans. Rather than rolling those dollar surpluses into treasury bonds, which the Americans are just going to devalue in the next crisis, they started lending them to oil producers, right? So by 2013, China had control of 80% of the oil in the ground of Ecuador for the next 20 years. Hey, Ecuador, you need dollars? Great. Here, we'll lend you the dollars. No. We don't want you to pay us back in interest. Just we want you to sign a contract saying, hey, you will give us 80% of the oil you produce over the next 20 years. Whoop, signed it. Copper, cobalt, the port of Piraeus in in Greece, excuse me. They tried to buy the port in New York and New Jersey. The Americans denied it. Because again, what would you rather have? A pile of treasury bonds the Americans are going to print away, or the port of New York, New Jersey, where, hey, print the dollar away. Who cares? We'll just raise port fees. It's a hard asset. So the Chinese have been doing this for almost 20 years now. And in the last 5, after COVID, the Americans, politicians finally figured out the game. And now they're kind of squawking, hey, we need to divorce from China. Well, it's fine, right? The Belt and Road, the whole Belt and Road thing. People are like, oh, well, it's not de-dollarization because they're lending in dollars. I'm like, of course they're lending in dollars. If you're China and you can't sell treasuries without it interrupting the market, I mean, they ran them down, but they've not really sold them aggressively. You can't. What do? Simple. How do you get rid of your treasuries? You've got a treasury asset in your left hand. You make a dollar loan in your right hand with your right hand for commodities, and now you're flat in dollars. That's what they've been doing for 20 years. And the Americans finally figured it out, American policymakers. What's the accounting transaction of that? You get rid of your dollars, you get long commodities before the Americans print 100 to 150 trillion for their boomers. And so that's the bigger context of all of this. And so we want to divorce from the Chinese. The Chinese, you've got to get rid of the Eurodollar system. You have to move to a neutral reserve asset. You cannot maintain the status quo dollar system and divorce from the Chinese. Can't. The Chinese factories back the treasury market. They back the stock market. It's just how it is.
A profound structural realignment has quietly transformed international commerce over the past 2 decades. Following the global financial crisis, major foreign monetary authorities halted the net accumulation of foreign sovereign debt, recognizing that holding unbacked fiat promises guarantees long-term purchasing power destruction. Rather than rolling ongoing trade surpluses back into treasury securities destined for currency debasement, surplus capital was strategically deployed to finance key emerging commodity producers worldwide. Under this resource-backed strategy, loans were extended in exchange for long-term off-take agreements securing physical oil, copper, cobalt, and vital maritime logistics hubs, rather than conventional interest payments. By neutralizing paper currency exposure in exchange for tangible natural wealth, foreign sovereigns effectively hedged against upcoming Western monetary expansion. This systemic shift demonstrates that global trade cannot sustain a unilateral fiat reserve framework while simultaneously pursuing industrial decoupling. As bilateral tensions intensify, international trade will inevitably transition toward neutral reserve assets, establishing a permanent structural departure from sovereign debt holdings toward hard commodity collateral. Consequently, the future of international commerce relies entirely on tangible assets rather than sovereign debt obligations. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.